All right. Last Friday in August, 10 o'clock, D Day, Fed Chair Warsh on the mic. 10 o'clock, we have that annual non farm revision. We'll talk about that. Do we have an issue here once again? Stream was deleted on Facebook. I do not know what's going on with that. All right, anyway, hopefully you guys can see me. It looks like on one of our Facebook pages it's not going through. Looks like the stream was deleted. Try creating or just remove this destination. I don't know. I don't know what's going on with these streams. Sometimes they work, sometimes they don't. Anyway, overnight, fair amount of data. Nothing of huge consequence. I would say net slightly bond unfriendly. The stocks sort of reflect that. Asia largely worse but mixed, whereas Europe largely better, and a lot of that slightly better economic data came out of Europe. We're indicating mostly worse here. Onshore NASDAQ, or I should say Dow, indicating slightly better, everything else slightly worse. VIX with a 14 handle, that's somewhat interesting. Bitcoin back to testing 80,000, of course. Brent crude worse on the day, although still in an 80 handle. Precious metals generally up. Dollar, I call it mixed. Not quite, but maybe slightly better versus most other currency. Nothing here to talk about at 8:30. Bonds, I don't know, maybe like cautiously optimistic. Is that what we want to say? We're in that we're slightly worse, but because we're not bracing for disaster, we're kind of hanging in there. Tens under 470. Generally speaking, and it's funny, I read this headline this morning and it was like, bonds are getting slaughtered. I mean, boy, I don't know that I agree with that. I would say that we're in nosebleed territory on some of these maturities. But, I would almost argue that the last week, 5 days, 2 weeks, if anything, net yields are, and MBS prices are better than where I would expect them. Now, understand my words. Not better than where I think they should be, but better than where I would expect them, given the lack of forward guidance, given the push and pull between the Fed and the Treasury. And by the way, if you haven't seen it, go on Facebook, go on LinkedIn. I think that's predominantly where you could find it. Rich Swerbinsky really talking about, it was an interesting piece about this two-man tango going on between Warsh and Besant. And, it was funny. For those of you that are on MBS Live, I'll be in the chat once in a while. And the day that Besant announced this repo, I posted something like, and I think I mentioned it here, kind of interesting, right? And I know that this is an oversimplification, but you have the Fed potentially tightening and the Treasury potentially easing, and or literally easing because of the announcement. Whereas the Fed, we don't know if they're going to tighten in September, and where actually the bets are that they're not. And how does that really work, right? And not that either of these are necessarily arms of the government, the Treasury sort of is, but how does one arm tighten while the other arm eases? That's an old trick in business a little bit, but at the end of the day, I think it makes for an interesting case study. And what Rich is talking about is that one manages the short end of the curve while the other is controlling the long end. And this is, which is very astute and accurate for the record, right? And so where one of the things you've heard out of me, whether it be in the Market Minute or whether it be on this or whether it just be random posts I might have done on LinkedIn or whatever, is the duplicity of things, the duplicity in our economy, the duplicity in our monetary policy, or at least the outcomes in our in how we spend money, potential austerity, in how this money hits the consumer or lack thereof, the delta between middle America and the coastal elites. When you look at all of this stuff, we're seeing that potentially play out in real time, in terms of how the Fed manages the short end, and the Treasury manages the long end, and all-time or 30-year highs in JGBs and benchmark Treasuries. It's interesting, and I think the real question is, at 10 o'clock, are we going to get answers? We'll see. The other thing that happens at 10 o'clock is the annual revision of non-farm payroll. Last year, we revised down 911,000 jobs. And again, if you've been following me for a while, and I see if I can pull up a revision chart. I talked about this, and I did a post about this quite some time ago, but we have this new phenomena, right, of massive negative revisions. So let me pull this up real quick. We will share a screen. Might be getting in the weeds here and boring you guys a little bit, but calendar year 2020, 1, 2, 3, 4, 5. 5 monthly negative revisions, 7 positive on the first revision. Net, a mean revision of -2, -58 in the second revision, -60 in the third. 1, 2, 3, 4, 5, 6, 7. That flip-flops as you go along. And you look at some of these, the non-seasonally adjusted, and when I talk about the calendar, what's interesting is the seasonal numbers and adjustments. I mean, look at how massive some of these are, right? And so 2020, we were still going okay. But this new phenomena of, revisions could go either way, but why are they? I don't know what's going on, Frank. Good morning, Bob. But it's failing for some reason. So you go to 21, right? And 21, here's a more normal pattern, okay? Positive revisions, generally speaking, across the board. And then you get to 22, and I think 22 is when you start, not so bad still in 22. We still, second and third revision still saw a mean negative revision, but not terrible. 23 is when these negative revisions start hit, and this is the monthly. This is not the annual that we're talking about. But 1, 2, 3, 4, 5, 6, again, 7 out of 12 months hit negative. 1, 2, 3, 4, 5, 6, 7, 8. On the second revision, 9 out of 12 months hit negative, and one of the positives was only +9. And just looking at the monthly, right? And so by the third revision, which one would think is the final revision, it's not. That's why we get the number we get today. But down 40, down 70, down 20, down 40, down 50, down 100. So I want you to think about this for a second, right? By June of 23, okay, we had revised every single number down. Now, the June 3rd revision doesn't come until what? August, September, October, whatever. June is reported in July. first revision August, second revision September, so October. So by October 2023, we figured out that we revised down what? 152, 300, we created 300,000 fewer jobs than were originally reported, okay? When you consider that we only printed, what, 3 months above 300,000 jobs, that effectively wipes out an entire month, okay? A net upward revision in July, okay, ended up printing about 50,000 more jobs, but August ended up 20,000. By the way, first revision was up 227 for the record, up 50. But then the third revision not only pulled back the positive, but we ended up worse than we originally thought in August. Down 70 in September, down 45 in October, down 11 in November, and then finally December was better, up about 70,000. Every single month ended up worse by the third revision except July and December, okay, in 23. Fast forward to 24. All right, and I'll do this quickly. Down 100, down 40, up 7, down, call it 70, down 60, down 90, up 30, down 70, flat, up 30, up 40, up 70, net, whatever that math is, but net worse every year. Every year revised worse than we originally thought. 25, this is where, government shutdown, it gets really wonky. Down 30, down 50, down 100, down 20, down 100, down 150. June, and this is when we talk about the summer, folks, June doesn't hit until July. Revisions hit August, September, October. Last June, we thought we created 147,000 jobs. We actually lost 13 by the time we were done, okay? Negative, August, we thought we created 22,000 jobs, was actually negative by the time we were done, okay? September, worse. October, we never printed. Maybe good for us because the final number was actually negative 173,000 jobs. Lost 173,000 jobs last October. November down 20, December down 67. So if I'm not mistaken, every single month printed worse by the third revision last year. To the tune of 58,000 times, what is that, 700,000 worse? Look at some of these negative revisions. 160,000. Less jobs than we originally printed in a month. I mean, staggering, right? And then 26. 26, January was better than we thought. February, significantly worse. March, better. April, better. May, significantly worse. June is trending worse. So what's interesting is these headlines are printing worse, but ending up slightly better versus in past years printing great or good and ending terrible. It's going to be interesting to see where we land. Now, here's what I'll say. Negative, right? Potentially flat or negative, potentially negative. 3 of the first 7 months potentially printing negative gives you an idea of where our economy is headed. When you overlay that to 25 and you turn around and you say, okay, net, we created what? 213, 333, 491, 510, 497, 477, 467 plus 469, 539, 639, 647, 547, 544, 474, 464, 457, 490. I think we created 498,000 jobs last year, if my math is correct. Considering we need to create about 1,700,000 for the year to keep up with population growth, overlay that into what we're doing here in 26. I mean, I don't know. Is that an employment situation that the Fed tightens into? I don't see it. You know, at what point is the Fed going to start talking more about employment than they do about inflation? When you look at that in those terms, the employment situation tells a much different story than folks might want to tell. When you look at 1.5% GDP, tells a much different story. When you look at consumer spending, which seemed to be a highlight, and you overlay that with price increases, when you look at PCE and you overlay that with certain price increases, tells a little bit of a different story about the health of the consumer and how they may or may not be contributing to the health of the economy or so-called inflation. Net, what do we do here? Well, in an hour, we've got Chicago PMI. In an hour and 15 minutes, we've got Michigan sentiment. I keep saying I don't know what I care about their inflation expectations, but it'll matter slightly. What I'm going to care about is almost more so than sentiment. I'm going to care about conditions. We're expecting both sentiment and conditions to be worse. That annual revision, forget about the negative 911, right, that was posted. I think what's going to be interesting is listen, and I've got to think about this for a second because, you know, maybe I'm wrong about this, but in theory, any negative revision for the year above 500,000 means that we actually lost jobs last year. When you overlay that, and I didn't go into this, but I'm going to presume, based on what I remember, that net, we were up multiple job holders and or underemployed. That means that not only did we lose net headline jobs, but on top of it, the jobs that we did create were worse jobs. Tells a much different story. So this revision at 10, don't sleep on it. We'll talk about it on Monday. But I think that it potentially tells it's going to go into an arguably longer term narrative that we're going to have to be patient about. But then at the end of the day, what also happens at 10 o'clock is Warsh. And what does he say about Iran? And what does he say about the impact on inflation? And what does he say about how they're going to react to it? And here's the irony in that statement. In theory, he's going to say nothing about how they're going to react to it because he's against forward guidance, right? So I think that 10 o'clock, get your popcorn out, and it's going to be interesting. Do we have more to gain than we have to lose? You know, there in some respects, I want to say yes. I mean, is a 4.8, is a 4.9, is a 5.10? Does that really make sense? And the reason for me showing you that BLS chart, does a 5% bond yield, right, match what I just showed you, or 5% 10-year, match what I just showed you? No, it doesn't, right? And how do we reconcile that as a Fed, potentially as a Treasury, potentially as a White House? You know, I know that gets complicated, right? But if you're behind, you know, those inside those four walls, behind that closed door, and if you're President Trump talking with Bessent about how to manage the Fed, who you can't manage, and how do you manage interest rates, and we post another negative number here at 10 o'clock, right? A final net revision. You know, and you're telling this story of two tales, of weakening employment situation and a complicated inflation situation. What do you do here? Going to be interesting. So what do? You potentially have a free look at 10 o'clock for whatever early rate sheets get posted. If I look at a 2-day chart, if all things are equal in the next hour, I would expect 6 coupon note rates to be better day over day on your rate sheets. I would expect 6.5 to also be better. We're talking about maybe an eighth in fee, possibly a quarter on the sixes. 5.5 coupon could be worse and likely would be worse. And 5 almost certainly will be worse. So if you see a rate sheet, 5.25 to 6.125 note rate, where you're seeing better pricing, that would imply that there's some value there. And depending on whether or not you want to take the 10 o'clock risk on, you may lock ahead of that. What I would say is, to whatever extent that 5.25 to 6.125 note rate price better, and you keep an eye on things and 10 o'clock doesn't go your way, that's sort of an insta-lock scenario for me, right? I think it's a little more complicated with 6.25 and above, because I expect you to see an eighth or a quarter better in price. So what I would say is, if that eighth or a quarter comes through on the rate sheet, then you're just getting market, you're not getting value. That's more of a 50-50 lock, in a vacuum 50-50 lock float consideration, not in reality, but I'm saying just purely based on rate sheet value. So if it doesn't go your way, is that an insta lock? Still probably. If it does go your way, now you're really playing with house money, right? Because you're seeing a rate that maybe doesn't provide value, and you expect it to get better, right? That's where you can really see real value on a later lock on 6.25 coupon and above. If those note rates are pricing the same or worse, and all of a sudden bonds rally, you may end up taking what might end up being, say, 25 basis point improvement and find a 50 because guys were holding back, right? Whereas that contemplation is a little bit different. If you're seeing, say, 50 better on 6.25 note rate and above, and bonds get better, in that scenario, and this is where it's weird sometimes, you may actually end up worse, because then guys are betting that rates are going to get better and then they pull back, right? So this is where it can get interesting. And then ultimately, purely from a risk standpoint, right, you don't have the ability now, once we get through today, and let's say that, you're hanging on Fed at 10 and then all the data next week. On 6.25 and above, you are in value territory. And if you don't want to take on that risk, I don't know why you're not locking first week, 2 weeks of September closings, right? If you're not gambling. If you're gambling that this data is going to be better, and I think that's a fair gamble. I'm saying 70-30, maybe even 80-20. Next week's data helps us, right? If you can be patient through whatever noise Warsh may or may not create, what you're betting on is better Iran news next week, better bond data, and maybe you pull out some value. But then the last thing I'm going to say about this is, what value are you trying to pull out? Because we're only about 30 basis points off of best screen levels, right, on 6.25 note rate and above in the last month or so. So this is where, if you wanted to do some legwork and dive into historical rate sheets, God bless you if you do. I'm imagining no one's even on that level to do stuff like that. What I would say is, if you were to go back and look at what your best 6.25 note rate, 6.5 note rate price was, and I'll give you a clue, the date that I would look at, probably August 13th. Before August 13th, I'd probably be looking at June 16th. Might want to look at June 26th. Might want to look at July 10th as a few dates, right? If today's rates are better, then call it 35 basis points worse, if that makes sense, if we're within less than 35 basis points of those dates, then it's almost an insta lock because you have less to gain than you have to lose, or you have more to lose than you have to gain, right? But if you're 50, 75 off those dates, that's where I'm more inclined to float, because MBS is only about 30 off those absolute best levels. But then if you're tying to non-best levels, we're only about 25, 20, 15 basis points off. So what are you really holding out for in the face of all this risk? That's for you to decide. What I happen to say is bulls and bears make money, pigs get slaughtered. We're playing this somewhat flat. I've got a slightly long bias in certain pockets, more non-production pockets. I'm more flat in production pockets because that's the meat and potatoes. And by the way, as I always say, if all of a sudden I'm right on my call, but wrong on how I've covered, because those are two different things, meaning I'm covering as though I'm worried about rates, but I'm saying I think rates are going to be better. Rates go down, there'll be more business. So you almost can't lose if you handle it the way I'm handling it. Have a great weekend. See you Monday.